Welcome back, everyone, to another episode here on Rabbit Hole Stories. And today, I am really exciting. We're going down a little bit of a data nerd session here, but watchers of and listeners of the show know that's more of my forte. And I'm excited to have the amazing Mark Connors here. Mark, we met when you were still at OnRamp. And I think we met for like 60 minutes, and 55 we spoke about data and stuff, and then the other 5 about the actual idea of the meeting. So
Yep.
it's great to have you on today. How has your day been so far?
It was, it just like when you look at something like Bitcoin and markets, you can get pulled in a lot of directions. So that today we had inflation data. I was writing something about the inflation print, and we'll touch on that. But you pull on the thread, and you can get brought into so many directions about, does it matter? Should I look at the price of gold going on today? And that's why, when you go back to what you and I talked about, it's so important for me to have a framework to work on. What's important? And, we call it, the rocks before the sand. When you wake up, understand what you want to look at by first saying, has anything changed on the week or month? You kind of go back and wake up, and like when I was on a trading desk, you looked at the orders you had from the previous day, and you make sure you got those orders back as a salesman to start your day. So I do the same thing. I look at where I left off, and where I left off was preparing for this podcast. And it was a great discipline because everything's going back to the level of debt and deficit spending we have in the US and G10. And all roads lead to inflation and more debt and more debasement. And that's maybe a good place to kick off, if you want, for how you want to ask me questions about the rabbit hole, because that hole is big.
I just remember we spoke 55 minutes about Credit Suisse because you used to work at Credit Suisse.
Yes.
And I was going back and forth how I was basically covering the Archegos scandal back then. And I was censored by my editor back then because, we didn't want to piss off Credit Suisse, was a sponsor of one of the newsletters we were writing on and these kind of things. And I always find it fascinating if I have, and I hope I don't offend you, TradFi people on who managed to get Bitcoin because they went that extra step further than what people in TradFi usually say about it. And they didn't just look at price, they understood the mechanics, they understood the fundamentals, and they bring their own takes to it. So how did you get from working in TradFi on Wall Street into Bitcoin? And what made you decide to then also chase a career in it and now continuously writing about it?
Well, it's similar. I'll answer your question specifically. I was at my desk at Credit Suisse in 2020, and my job there was to look at all the data across the prime brokerage platform, integrate it with more broad-based global macro data, economic data across G20 and beyond, as well as market data, returns of liquid market assets like equities, credit, commodities, rates, et cetera, and try to look for patterns. And I did this for hedge funds. They were our clients. And I would share with them this data that's slow moving, like macro, quarterly data reports, maybe monthly, as well as the daily data that we got, that we aggregated and shared back to clients about positioning in, say, tech sector versus the energy sector. Were clients overly long or short oil contracts? Again, aggregated, anonymized, and everyone, agreed to ingest and share the data. And in the engagement with clients, I found out that, well, sometimes I lost 5 clients in a year. The hedge funds, even though they were well-resourced, had money, very smart people, they couldn't beat the market. They couldn't create alpha. So over my over a 5-year period, that was one theme. And then I figured out why. As I said, I'm dumb, not stupid. I pulled back and I said, oh my God, it's the Federal Reserve that is really the arson and the firefighter when it comes to market volatility. They are buying up securities when it gets tough, like say they'll step in as they did in 08. They stepped in as they did in the repo spike of February 19, and certainly as we saw in February of 20. So when that happens, the best laid plans of a hedge fund manager to buy a certain stock and sell another goes out the window. It is simply everything is going to be okay. So all that hard-earned work about being long one name, another name goes away. So it was that realization about why the clients were getting impaired that led me to say, we have a debt problem. It's so dire that the central bank of the United States, along with others, will do anything to prevent another large-scale credit default. We will never have a credit default like we had in 08, at least not without the Federal Reserve and Treasury doing everything they can to prevent it, which means they're going to be buying securities and dampening volatility.
So in order to not have another default, basically any central bank in the world has to become a hedge fund and in itself also be part of that game. Because if you think as a layman, at least if I speak to like normie friends, who don't think about finance, they maybe put a little bit aside in savings and that's it. They buy some ETFs and stuff. They always think central banks are the secure place to go. They're very conservative. They don't take on any risk. And as a Swiss, if I go into like 65% of the exposure in the Swiss National Bank, for example, is in 6 companies in the US. I don't know if that's conservative. I don't know if that's good. We had like $135 billion loss 2 years ago or 3 years ago at this point in that bank. So I don't really know if that's the smart way to go. But to get into the data and stuff for regular listeners and viewers of the show, what is the main issue with the Fed becoming more active, I would say, with buying assets, with being an active participant in the market and not the guys in the background saying like, hey, you shouldn't do this or that? Is there an outcome where you go, oh, if that continues this way, it's not looking pretty? Or what are the repercussions of that involvement?
So the repercussions, let me answer that in 1 second. Going back to the central bank coming in and not allowing any failures, that's like a parent coming in and saying, oh, you made a bad decision, I'll bail you out. Mm-hmm. I'll pay off the police. I'll give you, I'll pay for new SAT scores. In other words, you're never going to skin your knee. So the kid never learns. The behavior continues to be poor behavior because there's no repercussions. We call that moral hazard. And it's the same thing for people as it is to a financial system. If bad behavior isn't punished, it'll continue. Now, the reason it matters, and central banks being safe, and the reason why it matters that they do this is they know that they can't look at 4,000 banks out there. So what they're doing is allowing banks to roll up, fail. I think there were 65 banks that were on notice that accounted for like the majority of the write-offs and losses at the FDIC last month. They want to get all those banks lower. So then the point is, if all the money becomes centralized, who has access to it? Like I know when I grew up, my dad was on a board of a thrift. I mean, it wasn't even a bank. It was just local people making loans literally to immigrants and entrepreneurs who had businesses. They knew them in the community. And that really happened. They met on Monday evenings after work. Not all of them were full-time employees. And they got together and they looked at portfolios and they made $10,000 to $50,000 loans. That does not happen anymore. There's too much at risk. It's more centralized. We have a much more untenable situation. And we'll talk about a chart, which will kind of give you an idea about where we are, where the Fed says, I can't risk any more credit, any more failures like we saw with SB, the
Silicon Valley Bank,
and others, where money can move in a moment. So why does it matter? We're in a situation, again, we'll go over some data, back to your point about being data needs, because there's too much information. If you understand some of these graphs and how hard it is to extinguish debt, and you got to deal with it, then I think that to me is how you become conscious about how Bitcoin matters. and how it is an asset without a liability assigned to it. It doesn't have something that can really hurt it. Like,
so was that moment when you went, the issue is the Fed, how quickly did it go from
a minute, in a second?
Oh wow.
I was actually bummed out. I was like, oh my God, we are going to have a currency issue in the US.
Yeah.
And I'll show you the debt. I was like, no one escapes this 120% debt to GDP. No one has. Zero. No fiat currency has. They just push off the eventual passing the baton to another reserve asset like the UK did.
And I'm interested.
In a minute, so Joel, I don't know why it happened, but in a minute it happened. I'm like, oh, Bitcoin can be that asset that we step onto off of the sinking ship of the declining purchasing power of the dollar. And that's something that I'd love to bring up later. Why do you have to get off the US boat? Isn't it better than the Argentine peso and everything? Yes, it is. But it's still not good if you're a wage earner in the US. Your wages are buying less house, less insurance, less everything. And if it buys the same amount of food, it's not the same food. It's been diminished. So that I don't know why it happened, but in a minute I was bummed out, arguably is depressed about seeing what the debasement of the dollar with the growth in debt and how there's no exit plan. I'm like, wait a minute. I've done some work on Bitcoin. There's always a window that opens when a door closes. And we can talk about that when we went off the gold standard and when inflation happened, what windows opened when the door closed on literally Germany and all the other countries on getting their gold. And when inflation went up, like, 10% oil crises, there's always a window that opens, but it's not one that is commonly discussed or shared. And it doesn't come out of the old system. It comes out of a new system. So that, again, for some reason, it came in a moment. I was lucky. And then I've been doing work for the last 4.5, 5 years, making sure that I'm right, not wrong on the efficacy and utility that is Bitcoin.
And before we get into the data, the last point there, I imagine when you realize this, you have desk neighbors, you have people working with you in these departments. Did you approach them and say, like, is it just me? Am I, like, colorblind at this point, that I only see issues? Or do you also see the same thing? And if they saw the same thing, did they also realize, like, oh, an asset as unique as Bitcoin is the opportunity out of a lifetime to get into this, or get out of this rather? Or was it just like the shoulder shrugs and like, well, what you got to do about it? This is how the system runs.
Very little engagement. No one. And to give you an idea about why, Wall Street is so complex, or our financial system is so complex, and Wall Street, large banks and boutiques are set up mostly to address very narrow aspects, to be specialists in order to navigate the complexity from a regulatory standpoint, from a liquidity standpoint, from an architecture standpoint, meaning how things settle where, what systems, that no one has the idea to go cross asset or take a step back, and you're not incentivized to, for the most part.
Interesting. So you really have to have that narrow mindset and that tunnel vision, unless you want to start up your own shop and try something else. But if you're locked into that system, you have to live this way. There's no other way out of that.
And there are some people like global macro strategists, risk managers should be looking at everything. They should be looking around the corner for volatility spillovers that aren't necessarily on their portfolio management, in their portfolio manager's books. So there are certain roles that can foster a more open or explorative look that would invite an opinion, at least on Bitcoin, but not many, Joel. And to this day, most people in traditional finance are still doing aren't there 1,000 Bitcoins out there? And why isn't this the best? It's like, it just gets a little old after a while.
Yeah, I imagine. But yeah, let's not hold our viewers and listeners back too much. For anyone listening to the audio version, I encourage you to also check out the video version because we are gonna share some slides. I will also link them in the show notes. But let's look back, Mark, and start in the history department of the money regimes, because there is not really only one way of what we do these days and how finance works. There have been different phases.
Yeah, there have been, and I'm only going back to World War II, and before the U.S. became the reserve, the dollar became the reserve asset in the wake of World War II. It was the pound sterling, and again, pound sterling because the note was equal to a pound in sterling, which we know it is not today. So back to how debasement happens. That'll be another concept. You can have another show. So now we're doing history, as you said. What I love about this is, people don't know about Bitcoin. We don't know how our financial system started. It's absolutely fascinating. And some people will say it is insidious because it concentrated power. Say whatever you want. It is fascinating. During World War II, I believe it was 1943, the meeting in Bretton Woods, New Hampshire, which, by the way, when you go to that hotel or the inn, which is still there, it does look like you're in the Swiss Alps as best as we can with, I don't know, maybe 6,000-foot peaks on our side. It's beautiful. And maybe that's why we had to invite the Europeans and make the treacherous trip across the ocean. The U.S. invited 43 other countries. We were the 44th to sit and say, okay, we're going to get through this war, but we need to rebuild and we need to be allies, not just in word, but we need to, spit in our hands and shake and really be blood brothers here. And the way they did that was the other 43 countries, agreed to take all their gold. And gold was the reserve asset for any country going back time ad memoriam, going back 5,000 years. Giving up your gold was giving up your seed corn, your first and your last child. But they agreed because things were dire and they knew that the ravages of war required extreme actions. So all the gold went into the Federal Reserve's basement. Sure, it was distributed out to other places, but that's where it went, down basement of Maiden Lane.
Do you roughly know how many tons that were?
I don't know the ton. I don't know the tonnage. So maybe we'll come back in a tweet on that after this. Mm-hmm. But a relevant point, given what's going on in the London markets today about who has the gold. But I'm not going to divert our attention. So when that happened, the government, the U.S. said, we're going to issue you dollars against that, and we'll only issue the dollars. We'll limit the dollar float based on the gold that we have. It was hard money, kind of. It was a new way of doing things. So to the viewers, there were other countries like Spain that had gold and that had notes that were issued against that gold in the 1600s that people used to trade. Yeah, certainly that happened, but never a coordinated global note that everyone agreed and supported with their own gold ever. So I belabor that point because only through that extreme circumstance could you have earned your way out of all this debt. The US, Japan, Germany, all of the Axis and Allied powers were devastated. They overspent. They were brought to their knees. The average age was brought down because of the number of deaths. They were, out of working age men, or had employment shortages when they came back. So it was really tough. So what did they do? They did extreme things. They made the money fast. That's what they did, and they were able to bring that money around and rebuild through the Marshall Plan and other plans. Both Asia and Europe rebuild, and it fostered other things like we talked about, Joel, on the offside about family formation. There was an optimism. So you had this spending, you had a demographic that was young and growing through family formation, And that is how the US was able to eat through all of that debt. There was higher inflation, there was growth, and there was a global rebuild. Think of that global coordination that fostered this. That was huge. And then I'll stop there in case you think there's clarification needed about why this guy is belaboring Bretton Woods and why it's relevant and comparative to what's going on today and not comparative.
No, I think it's just a pointer for the audience again. Look at the data and see how quickly the US went from a basic surplus, so they were making more than what they were spending in terms of GDP, up to actually losing 20% of whatever they were making compared again in the GDP within like, what is that, 4 or 5 years maybe? So they 1.25x'd it just during the war. And frankly speaking, war, I think, is a good excuse to do that, as you've mentioned, with all of that data. But just looking at these things, and then later on, we'll get back to that, how crazy it is these days.
Yeah. And that's equivalent to, imagine you as a viewer, say there's $100,000 income that you have. You're doing better than the average bear. Good for you. And you're spending, and then you have $120,000 of a credit card that you have to finance. That's what 120% of debt to GDP means then and now. It means that, yes, the income generation or the machine is at 100, but there's debt accumulated. And so back to you as a person, say you have $120,000 of debt and you're making 100,000. And what happens if your coupon goes up? Your cost of credit goes up from 2% to 4% to 5, which is happening in the US. What does that do to you? It's not good. It can choke you. So you have to do extreme measures to get rid of it. That's why we're in a very unique period. And guys like Joel with your investigative media background, which is one reason I want to come on, because how you look at things, it's exactly how I look at it, with an eye of curiosity and a structured approach to try to understand and deconstruct a system to say, how did we get here and can we get out?
But looking at the chart again, the plan did work. You have to say that, you have to admit to that, even as a fellow Bitcoiner.
Yeah.
We all know the Bretton Woods story. We all know, probably the stories and how the Fed was founded and all of that stuff. It did work. And then guess what? Shit hit the fan show again. There is another war coming up. And the US, and specifically the White House at this point, in collaboration with the Fed, has to do something, because they are literally hours away at this point from bankruptcy.
Yeah. And I can go to maybe the next graph. This is looking at deficits. So we spent more than we had because we were at war, and it kind of got okay back and forth. But then with Vietnam and funding a war, we started to go into the largest deficit that we had since World War II. And then 71 here, the trajectory just went more and more into spending. The only way you can spend more than you have is, if you're on a gold standard, is to get off the gold standard. So in August of 71, Sunday night, the Sunday Night Massacre is what it's called, the U.S. got off the gold standard and issued more dollar bills than they had in gold. And that caused and unleashed a decade of inflation where gold went up 14 times, from $32 or 41 at that time to over $500 by the end of the decade, with a high of 800. And oil went up 18 times, from $2 to over $36. So it was absolute inflation, and obviously a lot of social discord, because when you have unsound money and inflation, you have a grumpy population that is looking for a fix.
Which is interesting for me, because I'm kind of like a politics and history buff as well. Mm-hmm. If you now look at the events following up to this, and I'm thinking about Jimmy Carter being worldwide recognized as like one of the worst US presidents, maybe excluding the last president. And then going into Reagan, and then obviously Reagan being now known for the deregulatory president, getting the ship back together again. But naturally, once that peak starts climbing again, there will be a point where everyone goes, as you said, you most likely head into a recession before we record, and you have to reset. You have to find new ways of getting out of these things, and then you're able to turn the things around, or at least you're able to slow down the tide. So also looking from these perspectives, I find it fascinating. And then going into like the Bill Clinton area with the repeal of Glass-Steagall, you see a lot of that stuff in here. So just looking at the graph from that perspective, I think there's a lot of these key events you can point out. But as you said at the beginning, no one is actually questioning how does the system work, because these are attributes to what happens, but not actually to what the underlying cause is.
Yeah. And there, things are complex. There are dynamics at work. Can a president in 4 years change an economy and make things happen? I mean, like the housing crisis in 08 happened in part because in 79, Carter I forgot what committee, changed the law about, they wanted to increase home ownership. So they lowered standards on loans, et cetera. So things accumulate, bad behaviors accumulate. One reason why when you don't have a market economy, that spring of risk can really coil because there's no one or invisible hand to stop a bad market, to stop a bad company, to let a bad company go bankrupt.
And then before we get into it, what I find interesting is you sort of move the goalpost a bit. You go from the store of value, the gold standard again being, gold. We then moved into oil, as you showed. And now for a brief period, at least up until a few years ago, you went into treasuries being the safest bet, let's say. And it's fascinating to me, just looking at the data, how a lot of that evolves based out of whatever is happening in these different regimes. And we can then, we all
Great
know where it
point.
leads to.
Yes, you're right, because oil, as it was rising in value, and it was what? A scarce, desirable asset. Sound familiar? So oil, as it went up, and scarce and desirable were important because here in the US, depending on your license plate, if it was odd, you can get, Monday, Wednesday, Friday. If you're even, maybe you got an extra day, you were on the other 4 days. And or else Sunday was a have at it day where both odd and even worked. But it was scarce and people were in line showing it was desirable. What did the US do? They said, oh, Middle East is a wreck. Remember, global warfare just went from Vietnam and exploded in many wars all over the Middle East and Northern Africa. And the US said, oh, well, we build arms. Let's protect Saudi Arabia, be the protector. And for that, they have to only accept purchases of oil in dollars. So that automatically created a bid for our dollar and therefore anything denominated in dollars. So I think where you're going at this, Joel, is that in Bretton Woods, gold was the reserve asset. Well, no longer, because we issued dollars. So what we did is we then made our U.S. Treasury the reserve asset. If you had treasuries, they were as good as gold. So you see that abstraction just made? That's important because I believe that treasuries, especially the long end, or in particular the long end, are no longer good as gold. They are not being bought by foreign reserve. They're being sold. The data supports that. And I think we're now in a world of a multipolar or multi-asset where Bitcoin has a place. Back to my rabbit hole moment or my aha moment where I'm like, oh, but we can step onto this emergent asset because it has a lot of qualities of gold. It's not centralized. It is anti-fragile. All these qualities that we make it. And just like we're seeing here, no one thought we'd have a petrodollar system. Money is a creation and a shared reality. And I believe the shared reality of Bitcoin, just like it was in gold, just like it was in treasuries and oil, Bitcoin is now, because of its digital nature, its scarcity, and the decentralized nature, that is one of the next, at least one leg of that new stool of reserve asset that is where all countries are going to build their wealth.
Yeah, and what I find super interesting is if you think about the perspective, we went from gold being the gold standard to, okay, we need another solution. So let's use the most unstable economy region in the world at that time, as you mentioned with the fallouts of Vietnam, and use the only commodity they have left, which makes them in turn able to survive, and turn that into the new gold standard. And we're not that far away from now having a purely debt-driven finance system that does nothing else than just issuing these treasuries and these T-bills or 10 years and whatever into a fully digital, decentralized, capped supply that is the complete opposite of what we're building on currently. So all of these cycles and all of these thought principles already happened. And although history doesn't often repeat itself, it does definitely rhyme. So you can see that slow, graduate evolution into, hey, let's try something else. So I also find this super interesting from that perspective. And maybe for the listeners, we will get into these terms before. Mark, can you quickly explain in a simple breakdown what the difference is? First of all, you speak of the Federal Reserve, you speak of Treasury, then you've got T-bills, you've got tenures. What are all of these things for anyone not familiar with finance terms?
Sure. So the U.S. has three branches of government: the executive, the legislative, and the judicial. So Treasury and the Federal Reserve fit under the executive branch, although the Federal Reserve is overseen and reports to the legislative branch, Congress, as we're seeing today in the Humphrey Hawkins testimony by Powell. Now, to the degree of how accountable it is to be seen, but looks like Senator Lummis is giving a little more pressure to be accountable for actions of the Fed. Thank goodness. The Federal Reserve was started in 1913 by J.P. Morgan after a famous compulsory and very unusual presentation to Congress when he was subpoenaed to say, is there trust in banks? There were a lot of bank failures between 1857, basically, in 1907.
Yeah, for anyone not familiar with it, JP Morgan basically saved the world economy at that point.
Yes. He stepped in and said, I got this. And he took his pound of flesh for sure. Because
kind of sounds like Sam Bankman-Fried if you think about it, but just it worked out for JP Morgan.
or who was it? Oh, that's right. It's right. Sam Bankman-Fried wanted to come in and save everybody. You're right. I forgot about that. You're so funny. God, that seems like so long ago. And the U.S. Treasury, like a lot of treasuries, will issue debt in support of government programs, whether it be healthcare, military, and the like. The Federal Reserve is a unique animal. People say it's neither federal nor a reserve, and it's a cheeky item beyond the scope of this call. But the Federal Reserve has two mandates. Their job is to work with their member banks, and J.P. Morgan is a member bank. Remember, he started the whole thing. Citibank is a member bank. Morgan Stanley now, because they're banks after 2008. And they have to report all of their operations to the Federal Reserve. The Federal Reserve says, I want to make sure that there's safety and soundness. I want to make sure you're operating okay. That's their oversight. Then they are an active player, and their activity is dictated by two mandates. They want to make sure that there's price stability, not inflation, not deflation, that things are stable because people like certainty. They don't want to act and move in an uncertain environment. So the Fed wants to have price stability. And there are certain open market operations. They work with their banks on adding or taking out reserves, increasing money supply, playing with the rate. That's their one mandate. Make sure we don't get too crazy with prices going up or down. The next one is full employment. They want to be able to have a longer term view also to make sure that their banks are supporting the growth of the nation that they are there to support. 2 mandates. Now, for your audience, Europe, the ECB has 1 mandate.
To fuck up the biggest time ever.
That's the hidden mandate. So they have 1 mandate, and that is price stability because of World War II. Because the scars of hyperinflation in Germany and the fallout, well, actually of World War I hyperinflation, and after World War II, we learned from World War I not to leave a country in duress like Germany was with reparations, et cetera, and it fostered nationalism, et cetera. That's why the Bretton Woods got together and said, let's make this happen. So we have, if everyone's fat and happy, they're less likely to build arms and raise an army against other nations. So that's why the ECB has price stability, because they're so focused. Think of the Germans. Even though a lot of European countries have high debt to GDP, Germany doesn't. They are the bulwark of the ECB. They are and there's other things that give them this ability, because we can talk about later, but Germany holds and drives the ECB, the Germany's central bank ethos still informs the ECB, but that's changing.
I mean, as someone living in the German-speaking region, 18 months ago, there was a discussion by, of course, left-leaning politicians to sell every ton, kilo, even gram of gold the Bundesnationalbank, so the German National Bank, still had to stimulate growth. So to do the MMT play, and just issue more, like sell it, dump it, issue more debt. Happy days. We're going to get out of the slump. And I think Germany, it's safe to say, they were at the brink of civil war, because every German, it doesn't matter what your political association is, was at that point going like, no, we did that once. Weimar Republic is something you shouldn't live through again. And I'm currently reading a book about the Deutsche Mark, which has also a lot of these fascinating principles behind how you basically broke a functioning currency at that point, driven by the National Bank with a different mandate compared to what the EWR, it's in German, I don't know what it is, the economic zone in Europe before the EU, was mandating. And guess what? When that doesn't work out with Germany, we got a superb crisis, as you can see now over here in Europe. So again, for the listeners and viewers, a lot of these patterns repeat themselves, and you don't need to look any further than the actual data to see what happened in the past and what's most likely going to happen again, maybe in a little bit different shape or form, as you've pointed out, with different demographics, different economies, different technology.
So I think what you brought up is, even though there's a history, long running for decades, it's being tested and threatened, because back to spoiling your children, because people can't handle the immediate pain of a potential recession. And I get it. It's not great, especially when you see what's happening to asset prices, and your neighbor who bought gold or bought Bitcoin or bought a house 15 years ago or 5 years ago, they're doing okay. But if you didn't have the money to buy that asset, you're not okay. You don't have reserves. So I do want to share this one graph, and then maybe we'll bring the conversation maybe to a few things that are happening front and center with markets, to make it more practical. So the thesis that Joel and I are talking about is, when Nixon broke the peg to gold, where you could only issue the amount of money based on the amount of gold you had in your basement. Like, think of it like a ledger, credit, debit. We're not going to increase the money supply. That would be in support of the Fed's mandate of stable prices. They broke that in 71. What you're looking at here is U.S. equities, the prices starting in 1981, so everything's at 100 in 1981. The money supply in the U.S. only, M2, which is basically the government's get out of money free card. They can issue more money to try to stimulate, like what Joel's saying, what people want to see happen. Sell gold and just give us the money. So that's money supply, which is a quick fix, like a sugar high. And then there's GDP, and that's just old time slogan. That's a business where you have a plan and you have your companies and they make money. And it's about the goods and services generated in a year. So what you see is since 81, we had that internet productivity. People got happy. Equities went up faster than the economy. That happens. A financial asset might accelerate faster than a business. It happens. People might call it a bubble, what have you. But then there's a recession. And guess what happens to the equity price relative to the economy or the money supply? It comes back down. Well, good old animal spirits come up again and we make money and we have a good 05, 06, 07, and then another recession happens. Now, look what happened in 08. In 08, you had almost a reset. You had okay, everybody, equities were a lot higher in 02, so you missed that boat. But when we have a recession and companies like Lehman go out of business or retailers or houses go into foreclosure, those assets change hands at lower prices. There's a change in ownership going on. So it's a reallocation of resources. It's a natural, always has happened in recessions. It was a good entry point, actually, obviously, to buy a hard asset like a house or gold. Gold actually was going higher, or really any kind of financial asset. But look what's happened since then. By letting Lehman go bankrupt, letting Bear Stearns go bankrupt, by saving Bear Stearns and letting Lehman go bankrupt, the U.S. government, and I believe every other government said, we thought it was okay to let Lehman go bankrupt because we didn't want to be seen as the parent spoiling the child. But now we know we can never do that again because in reaction, the whole system almost came undone.
And going back to our unique combination there, this is why Janet Yellen called the then finance secretary, Karin Keller-Sutter, in Switzerland when Credit Suisse was in trouble, because everyone had the same writing on the wall going, Credit Suisse may not be in terms of what the market value of the bank was, a big bank compared to like a Goldman or JP Morgan, but the fallout of all of the branches they have in this very complicated finance system was another red warning signal for everyone involved going, if we have another one like these ones, we have to be really creative now in how to quote unquote save that bank, which the only real saving they were able to do is to basically do a government bailout again, but not call it a bailout this time because they knew it's a political fallout. So you see a lot of these things coming back. And what I want to point out to people not familiar with data, if you have a lot of that delta between the breakout with equities and the GDP, and it comes back down during recessions, take a look at January 23 now, how big that gap is, and imagine if there is another big time recession, and a proper one, not one where people get rich on equities and poor waiters and stuff can't work like COVID. Imagine that pulling back together and how severe that the effects on that are. So just at looking at these graphs and imagining what could potentially happen in the future, you need to have an asset that squeezes that delta incredibly fast and also safeguards the future. And I guess we all know what kind of asset that is, but we're not going to spoil that. But just looking at that stuff, it's scary. It's scary to imagine what the repercussions would be if there is another major recession and pulling everything together.
Yeah, and I think that government officials, the Fed, Treasury, others are keenly aware of the wealth effect of the equity market, which feeds pension funds. So therefore, it's a source of income for individuals. It's obviously a currency for companies to raise capital and employ people. All that's true. So you're right. If this were to come down, that's basically the mother's milk now of the of the U.S. for sure. Given it's 45% of all equity capitalization is in the U.S. alone. So I think that's a sacred cow, and they're going to do everything they can to keep it alive. That's why a full recession with default cycle, we don't have the data to understand the fallout. There's just we don't know.
Yeah, and it's basically fallout on all fronts. As I mentioned earlier in the show, I think the S&P still has something like 58, 59% exposure to 6 companies in the US, so heavily centralized. And the S&P is technically being looked at as one of the good central banks doing a good job. It helps also that they got the Swiss franc, which got off the gold standard last, so that's a different story. But imagine the fallout with central banks such as the Bank of England, for example, who has much bigger problems and much bigger fish to fry. So a lot of these things not only have an impact in the US, but globally speaking, because everyone that's further away from the resources the Fed has available will have a significant worse impact than if you were a JP Morgan or a Goldman or whoever's closest to that money printer.
Yeah, and when you what the other reason why I wanted to or I was happy that you invited me to join the call was because of your European locus. And ever since '08, when the Federal Reserve opened up their ability to offer swap lines to other countries that were having trouble in order to get access to dollars, which are the most secure of the fiat currencies and accepted, we became one water table. Risk is global now. Yes, the US is a reserve currency, but we are reliant on other flows. We cannot get too far ahead of other countries in our primacy. We can't have our dollar be too expensive, meaning that we can't have the euro go to 90 cents to the dollar from 103 now immediately. That would create an imbalance and would hurt everybody globally. So, then you ask, why are tariffs happening? We're going to put that over here. We're going to say tariffs are noise. The signal is looking at the shared global debt across the globe, the aging demographic, and the tightrope that all these countries have to walk in order to avoid a recession and keep employment and incomes working. It's getting harder every year. And that's why, so do you mind, Joel, if we look at in the US, we had inflation print that was higher in the US than expected. We had some employment data, but I call this my scorecard. We talked about lofty thoughts, central banks and fun stories like banks failing and all that good stuff. But let's look at I love the scorecard. These are global assets, a sampling, not all global assets, but I look at Bitcoin and gold, NASDAQ versus S&P in the US, the tech equity, the broader index. I look at the US Treasury ETF. That's looking at Treasury bonds between 7 and 10 years, and they're wrapped in an ETF, making it easy for retail and advisors to own. It has coupon flow, and it tracks very closely to how treasuries trade. You have oil, and then you have a new entrant, which I brought in only recently because it was such an underperforming index, we just didn't look at it until recently. Now, do you want to take it from here, give a little history of the stocks 50 or European equities, Joel, in generals?
I mean, we could get into it, but it's basically European equities do not have a track record of being attractive. Let's call it this way. I would even argue the European women are compared to the US women. Sorry for any US listeners, but in terms of finance, Europe is not sexy. So if capital allocators, and specifically Wall Street and institutional allocators, are looking towards Europe as, I wouldn't say a last resort, but a backup of a backup plan, we're not riding the ship good enough at that point to say, yeah, we're comfortable that everything is stable and sound, that we're growing at a healthy rate.
It's not a ringing endorsement about the direction of risk markets. It means I'm hiding. And you're right, because when you say not sexy, you think of returns and beta.
Mm-hmm.
I think the largest stock is LVMH, a luxury brand, not a huge grower. Cash flow is great, been around for a while, has brand dominance, but it's not something like Nvidia, that will grow compound at 50% a year for 10 years. So the US has tech and Europe does not. So why, for goodness sake, are you having a 10% year for 6 weeks of the year, 8 weeks of the year, 6 weeks of the year, 5 times, 10 times more than NASDAQ? And in a month that's down for equities, it's up 2%. And on a day when the whole market's selling off, why is the Stoxx 50 up 60 basis points? Even
Yeah.
outperforming gold, that's flat and is also having a great year. It's because it's low risk.
Yeah, and just to mention, like thanks to AI, we spoke about the pre-taping about our new love for AI, both you and I. I just asked Claude, like, what are the 10 biggest stocks in Europe? LVMH, as you mentioned, and then you get into stuff like Novo Nordisk, pharmaceutical, ASML, semiconductor, Nestle, Roche, Switzerland is keeping the flag high here, Novartis also, another pharma stuff. Shell, L'Oreal, SAP in Germany, and Total Energies in France. So it's not sexy business, as I've mentioned. It's not a fast-growing, innovative industry like Nvidia and all of these FANG companies. It's really the backbone of probably at one point family businesses. They're growing at a slow rate. Arguably, as a Bitcoin, you could say that's a safe thing, set the foundation right, but there's not massive breakouts. So for capital allocators to look at this and go like, well, we might as well do that and jump on that ship, that's not a good signal. In fact, that's a very big red flag at this point.
It's not Mr. Right, it's Mr. Right now. And right now, people are scared. So they're going into 13 PE indices and gold. And so clearly that's what we're seeing today. And pulling back the lens a bit, looking at the longer term view of things, the one reason why we do focus on Bitcoin is because it has a persistence of outperformance. It's not a bubble of sorts. It's something that has been growing as people look at alternative stores of value that can't be debased or used to maybe fight a proxy war or fund an initiative that we find is silly or not supportive, because we find out now that bureaucratic spending can happen without being voted on, things like that. So I just like pulling back the lens a bit and showing how look at gold, 10 years, 9%, underperforming equities. But look at the 5-year compound annual growth, 13%. Investors started to pick their head up a bit, and it outperformed the S&P on a 5-year basis. Over the last 5 years, gold over S&P.
Warren Buffett must be crying in a cell around.
And
or Dave
he's like, I wish Charlie was here so I could complain to him. So that's the and then just looking at sort of bringing it back down to markets. We have a top-down approach. You and I have been talking about macro factors and World War II and all this, but let's look at gold. There have been 2 inflationary periods in the past. You're looking at the volatility of gold, and people think volatility is bad. If the VIX goes up in equity, or the not V2, is it V2X in Europe? I think.
Yeah, V2X.
Goes up in Europe, it means equities are going down. That's true. But with a commodity, it can be different. Gold went from 4% vol to 88 vol. And in that time, it went up 1,400% as volatility went up. It's a concept we're not used to because we haven't seen it in so long. It did it again in 2008 when the Federal Reserve and Treasury came in and just, issued $1 trillion to save the banks, put $3 trillion on their balance sheets. People said, well, let me buy something that can't be printed, that is a little more scarce and desirable. They bought gold. Gold outperformed equities materially over that period. And we're seeing it again. So we're in that new period that regime of, I think, a multi-asset reserve system, and Bitcoin is having a place in it.
Yeah, now looking at that data again, as you point out, central banks or the Fed at this point, but any central bank, started buying gold as well when they knew we're most likely not we don't have enough tape to hold the system together, or not enough glue, or whatever you want to use that as an anecdote. And now we've seen the gold price rip, as you've shown with the compounded annual growth rates in the 5-year, in even year to date so far, or the past year, let's say. So whenever gold is ripping, and at this point you start seeing central banks hoarding, and if you actually read the World Gold Council reports, it's been happening since, I think, September, October 22, something along these lines. It's getting crazy.
I'm gonna plug my Substack here
Mm-hmm.
because, you know, part of what I do, I'm not a news reporter. I don't come out first thing and talk about the immediate prints on what's going on. I think the value is in assessing things, over, longer periods of time, and understanding how to look at systems. So, for example, today's inflation print, I'm putting something out later today and linking it to previous Substacks I've written. And my Substack is Mark R. Connors. And I wrote a piece on treasuries, Joel, about how since '08, how the G10 have been net sellers of gold, including, I believe, U.S. and Switzerland, and maybe a few others, I believe, but I had the data there. And the net buyers are those that don't enjoy a reserve status. Emerging countries. It's Russia, China, India, and one other country with a majority of buyers between '08 and 2023 when I did the report. And it's happening again, as you said. They're buying more gold. So we are approaching another period of dislocation, I believe. I do not think it'll end in a depression or a failure.
Mm-hmm.
I think the central banks will coordinate to stop it. It won't make it go away. There'll be winners and losers, just like there were during COVID. If you own assets, I can't guarantee it'll be exactly the same. But I think, looking at and doing the work on Bitcoin, which is outside the system, it is a commodity in that it is decentralized, no single issuer. It is scarce, it is desirable, and it's proven over 15 years. That's something that you and I, that's why you're doing what you're doing. And that's why I'm focusing on it, because I think it's still underowned. And I think the problem is only growing and becoming more aware and more at risk of springing on us about another forced asset purchase by central banks as people become less confident in the system.
Definitely. I think that's even though it's a grim outlook, I think that's a good way to add maybe the first part here, Mark, because I definitely want to have you on in a few months as well. You mentioned the Substack. I will link whatever Mark said and the slides in the description below. But if people want to get in contact with you, where's the best place to find you online?
LinkedIn is one way. My email, love getting emails, mark@riskdimensions.io. But yeah, LinkedIn, I'm on Twitter it's at Risk Dimensions is my Twitter handle. Those are the best ways. And Substack too. It's been a great platform, good engagement. And there's a series of work that I do that we try to have fun with it. We try to tell stories along with the data. So it's not like waterboarding our audience.
Perfect. Definitely make sure to check out the links below. Mark, thanks for your time and preparing all the slides. And I'm looking forward to having you back on. And for our lovely listeners, as always, very important, stay curious, guys.